Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE, episode 191. From Dublin, Ireland to Dublin, Ohio, and across 188 nations worldwide, this is Get Rich Education. I'm Keith Weinhold. We're talking about fourplex buildings today and how they occupy a special place in the real estate investing world. And I'm not just saying that because I have a soft spot in my heart, since a fourplex is the first property of any type I ever owned. One thing that makes 4-unit apartment buildings unique to you is that it's the greatest number of doors, 4, that you can have all under one roof and yet still qualify for the advantageous conventional residential financing. Even though properties with 5 or more units in them might be lived in by families, therefore a residential use type, you still need to get a commercial loan because you've crossed the threshold above 4 units. That's just how loans are structured in the U.S. And historically, you can get 10 conventional financed properties of 1 to 4 units at those best financing rates and terms. So yeah, therefore, with single-family properties, you could get 10 doors this way. With duplexes, you could get 20. With fourplexes, you could get 40 doors this way. Now, when you think about it, it's actually pretty generous that Fannie Mae and Freddie Mac residential loans go up as high as 4 units in one building, since I think that you can make the case that there's a real business intent implicit within duplexes and higher. Commercial loans on 5+ units have higher interest rates than 1 to 4 unit properties do too. Okay, all that right there, that might help a fourplex look good on your paper pro forma. But now let's take that down to the street level, right? There's seat knowledge and then there's street knowledge. Here's the street knowledge. Many cities in the United States, and I live in one of them, they have these little pockets of fourplexes kind of dotted around your city or your town. And the fourplexes were often built 30 or 40 years ago. Each fourplex on the street has a different owner, so there's no uniformity to the look there. And see, there aren't any owner occupants on that street. Therefore, the neighborhood can go to heck. And it might even start looking pretty slummy in these older fourplex neighborhoods as, you know, residents are parking their motorcycles on the lawn and there always seems to be trash blowing around. And I know that we have some Europeans right now listening to this, shaking their head as I refer to a 40-year-old neighborhood as older, but this is the United States. Now, see, in single-family income properties, you have safeguarded yourself against blight because there is typically a mix of owner-occupants living on that same street where you have your income property. But today's guest is going to tell us about what he and his company do. What they do is they buy a large tract of pretty prime land near the fringes of a metro area. So it's not a little pocket, and it's also certainly not any one singular infill fourplex. Instead, they build brand new fourplexes on this large tract. And then following construction and occupancy, they see that the properties are managed in a consistent way across all of them, and therefore that safeguards you against blight and disrepair. They control the neighborhood, and they really kind of are the neighborhood. And these are some really nice looking fourplex properties too. Let's meet today's guest. Today, I'd like to welcome onto the show Steve Olson.
How you doing, Keith?
Steve, hey, it's so great to have you here. You offer something so interesting with fourplexes, brand new fourplexes for investors. And fourplexes, they occupy really a pretty special place in the investing world. But before we get into that, I just want to ask you about how you got into the whole real estate investing realm.
Yeah, sure. Happy to help there. I was in college at the time, believe it or not, and I wanted to be an attorney. I was getting a degree in political science, and I was going to go take over the world, right, being an attorney, because that's what you think they are. And then you realize that most of them don't really have those big, glamorous, high-paying jobs, right? So my best friend at the time was actually working for a real estate, a guru, if you want to call it. He was doing lots of miscellaneous jobs over there at that company. And so I took a job over there and was basically in customer service, helping ship boxes, answer questions, and those kinds of things. And down the hall, I was very lucky. They had the real estate coaches down the hall. And this was back in 2001,
Okay.
by the way. And it was a lot easier to flip real estate then than it is now.
There's a lot more competition now. Yeah.
Yeah, it was probably a tenth of what it is today back then.
Wow.
So I thought I was going to do my very first house. I ended up doing that house and dropped out of college to eventually focus on real estate completely. I did finish 12 years after that, but I've been in real estate in one capacity or the other ever since then, mostly in the rental space. I like rental properties. I noticed back in the real estate crash of 2008 that all of my investments went sideways except for my rentals because people still needed a place to live, even though it was the end of the world. I think on CNBC, they said it was the end of capitalism or something dramatic like that. And people still wanted to write me rent checks. So that really stuck with me. And that's really has been where my passion is.
Even if capitalism ended, people would still need a place to live. I often tell people when you're cash flow centric and you think about a market, downturns can actually be good for you because my rent income went through the roof during the downturn. So tell us just about how you kind of transitioned into what you got into today with the Fourplex investment group and just what that is.
Well, it's a pretty interesting concept. I think most investors, probably a lot of them that listen to your show, they want fourplexes. In the market like it is right now, that's hard to do. Anything that's out there, and frankly, Keith, you could say this about most real estate now, but anything that's on the MLS or on the open market is really, really expensive, really cap rate compressed. But fourplexes still do, even in a compressed cap rate environment, offer some significant advantages that go beyond just that cash on cash return aspect. So I got involved with the Fourplex investment group. We call it FIG for short. We can do that on the show here and save ourselves a lot of oxygen. We'll just call it FIG.
That's sketchy.
Yep, it works. So one of the original founders for FIG approached me a few years back and kind of knew of my work in the real estate industry and said, hey, why don't you come over here and help me out a little bit? I didn't really get it at first. I thought, oh, that's kind of neat. A couple months in, I said, wow, these guys are onto something. This is pretty intense, because it really gave investors the best way to take advantage of all these multi-dimensional advantages of owning fourplexes. So, yeah, I got involved just helping out. I ended up being put over the state of Texas for FIG, and now here I am. I'm the director of sales and client relations over here. So I launch new projects and interface with the development team, with the builders, with our property managers, just to kind of be one point of contact for the investors that come to FIG to buy fourplexes.
Now, we are in a pretty hot portion of the real estate investing cycle, and sort of like you alluded to, it can be really competitive to get a fourplex building. In fact, if one is on the MLS, not necessarily, but that might just be an indication that it's a dog, that it made it that far, that it made it onto the market. But outside of being within a particular cycle, what I would say over the long term, Steve, is that where most fourplexes are built and what they look like today, since so many fourplexes were built 30 to 40 years ago, back when it was sort of profitable for builders to build those things more historically, and they don't build so many of those things now, those neighborhoods typically look pretty yucky. In fact, the first property I ever owned was a 1983 built fourplex, and I can drive through that area today, just like I could drive through that area 10 or 15 years ago. And the first thing you notice is there are dumpsters all over the place because it is a fourplex neighborhood and cars are parked every which way and people just don't really respect the properties all that much. And it's just not really the nicest looking place. So, the neighborhood has kind of lost control. I think you've done something with fourplexes that kind of brings that control back. Tell us about that.
Sure. And you're absolutely right. You use that highly advanced technical term, yucky, to describe those neighborhoods. And that's what they've become. They weren't that way originally. Anything when it's new usually can hold up for a little while. But if you've heard in psychology of the broken window theory, right? One broken window on the block sends the whole neighborhood into a tailspin.
Right.
And that's especially true when you have a high concentration of tenants, right? When you're dealing in residential properties and you have a high concentration of owners, there's that pride of ownership, right? A broken window would get fixed or a problem would get fixed for the most part. You've got junky owners too. But when you have tenants, though, I mean, they just care a lot less. They might be really good tenants, but they still don't care as much as an owner. And so the tenants aren't really taking care of the fourplex and the grounds. And then, you get an owner who maybe is having a little bit of trouble financially. So they hurry up and they get some tenants that aren't as well qualified. Those tenants are leaving garbage all over the place, parking an old car on the lawn. Then the guy across the street doesn't want to fix his roof. The shingles are sloughing off of there. They're losing that mineral base. That roof is looking really tired. And this is the beginning of the end, right? And it's a problem. And so you see, exactly like you described, many of these fourplex little hodgepodgey developments are very run down. We have some really good video clips on our website of one of them. And the funny thing is the clips of the one that we have are one that I lived in when I was a little kid. And it was a lot better then than it is now.
Wow.
So what we have done are two things. Number one, you do have to control what is happening on the outside of these fourplexes. And this can be a dirty word in investor world, but we put a homeowners association on every one of our projects.
Yeah.
So a fourplex project to us might be 30 different properties, but there's one HOA that kind of rules over this thing. And we make it investor friendly because we're the ones that draft the bylaws and the CC&Rs for that HOA. We don't want it to be that busybody HOA that kind of terrorizes you as an investor. Rather, the only people on the board, the only members of that HOA are you, the investors. You won't want the same thing, a clean, stable development that rents well. So if the guy across the street decides he's going to let somebody park bad or hang up weird drapes in the window, do these things that begin to devalue, the HOA gets him on that. It happened the other day. One of my clients emailed me, "Hey, I got fined by the HOA. What's going on?" And I said, "Oh, well, you got a doghouse out in front of your property. The tenants had built a doghouse out there, and that thing is gone now. That's not going to fly." So that really preserves the value of the neighborhood and gets rid of kind of that stigma that these fourplex projects have. Now, I mentioned, Keith, that's the outside. But, you can do everything in the world on the outside. If what's inside of these fourplexes isn't any good, eventually no HOA in the world is going to help you, right? It's going to be a problem. So number one, we've got to build these in good, stable neighborhoods, right? It's not just where you can get land the cheapest. We could put up a bunch of these in the desert tomorrow, but nobody cares. So it has to be a good, what we would define as an A-class neighborhood, but also we've constructed these fourplexes to make it so good tenants actually do want to live in them. We don't do this standard boxy looking 2-bedroom, 1-bath fourplex. Our fourplexes are actually 4 townhomes in a row, and it's one tax ID number. That's really kind of our secret sauce. So financing, it gives you a bunch of advantages, but speaking specifically to tenants, they don't think that they're renting a fourplex in a rundown development. They think they're in a really nice townhouse project, and they get anywhere from a 1,400 to a 1,700 square foot, 3-bedroom, 2.5-bath townhouse, typically with at least a 1-car garage, sometimes a 2. And these developments have amenities. A lot of times they have a little gym, they have pools, walking trails, parks. This kind of project attracts good tenants. So what's happening on the inside is good. What's happening on the outside is good. This is the kind of stuff that you can really see yourself owning for a long time. It's what you feel like is stable, and you can sleep well at night owning this kind of a property.
On older fourplex neighborhoods, kind of like those conventional yucky ones that I mentioned, the pro formas can look really good on those. But you've got to think about the way they look. And when a tenant makes more income at work or gets a little more money, they're going to move right the heck out of there into a better neighborhood. And that pro forma might not really perform for you in that older 30 to 40-year-old fourplex neighborhood when the tenants are leaving annually. But what you have there is a really nice looking property. And when it's townhouse style, not the old style fourplexes where they're usually like 2 units upstairs and 2 units downstairs.
Yep.
When it's townhouse style and everyone has their own separate entrance to the outdoors, it feels more like their own, and they're a bit more likely to take better care of it and want to stay there because they do have a measure of privacy, even though they're in a small multifamily property.
Yeah, you're going to get people that typically stay in these things for a couple of years at least. And the ones that do leave, most of the time it's because maybe they're going to go buy a house now, right? Or maybe they got transferred out for a job. It's rarely because I found somewhere better. They're not likely to find something a whole lot better, at least in any kind of quantity when it comes to the rental game. That's the whole point.
Fourplexes are just really an interesting asset type. And with regard to the number of units in a property and the type of tenant that you can attract there, with a Class A single-family investment property, I like to think of it as, well, you usually will attract a Class A type of tenant. But with a Class A apartment, you kind of drop down a notch and you attract a Class B tenant in that Class A apartment. And with a Class B apartment, then you might attract a Class C tenant and so on. But with this, when it really feels like your own and it's nice and it's new and you have an HOA controlling things with codes, covenants, and restrictions, you really can potentially get that A-class tenant for an A-class property.
Well, that's what we're going for here. Yeah, we typically are getting that kind of a tenant, somebody that's going to stay a while. And if they don't, they take really good care of the property. And like anybody, we've got our exceptions. But I think that's what you're doing with a fourplex. When you have a fourplex, you spread out that liability and that risk. You've got 4 income streams and 1 loan to service. And that's why people really love those. This whole concept that we do, Keith, was invented in the downturn, actually, back in 2010 as a hedge. There's a lot of money on the sidelines back in 2010.
Yeah.
That's when the market was starting to kind of think, oh, maybe the world's not going to end. Maybe we actually do need real estate. And the whole thought was, well, this is a good downside hedge. I mean, it happens to be going crazy right now, and it's really great. But that's why we like these, is when things aren't great, we feel like this is a product that still performs.
Right. But now you're describing where we were in the approximate bottom of the market in 2010 in a lot of United States metros, kind of in the opposite place now here 8 or 9 years later. I think you've kind of come up with a solution to compressed cap rates and these sort of investor-dominated projects that we have today. And just to drop back before we go on, a compressed cap rate or compressed capitalization rate, that just means that more investors are bidding up the prices of assets. But see, that does not make your rents rise proportionally to that higher asset price. Tell us more about what you do to fly in the face of compressed cap rates for investors.
Compressed cap rates, you explained it well. It's just properties are more expensive, right? More investors are going to that kind of asset because they want that return. And it's probably, like we said, because it's safe. They think, if things don't go well, I'm okay in this property. So compressed cap rates, there are a few ways to deal with them. Obviously, everybody wants a good deal. They want to get the best price they can on real estate. And when you go out there, if you hire a real estate agent in almost any market in the U.S. right now and say, hey, go look at the MLS or go find me some fourplexes, you're going to be pretty underwhelmed by what they bring you. You're going to say, I got to pay that for that?
Right.
And somebody goes through this, they get beat over the head by the market enough, and they say, okay, I've got to be able to get a better price or do better here for my money. And if you're willing to hustle or be smart or be patient, you may be able to do that. And one strategy that many people go to, we do kind of a different version of this. It's referred to as the value add, a value proposition, right? We're going to go find a fourplex that's really run down, like the ones we were joking about earlier. I'm going to buy this thing because the owner doesn't want it anymore. It's distressed for whatever reason. There are a million reasons. I've heard them all. And I'm going to get those tenants out of there, and I'm going to put $6-7 grand into each door or whatever it takes. And I'm going to optimize this and I'm going to raise the rents. And because it's valued based on cap rate, the money I have into it now versus the return I'm getting, I got a really good cap rate now. I'm a happy camper. And that is a totally legitimate and very effective strategy. I've done it myself. I have a lot of friends and a lot of clients that do it. But if you are in Seattle and you work for Microsoft, or you live in New York and you work at a law firm or whatever, you're busy. We have this term in real estate, highest and best use, right, Keith, where a piece of real estate needs to be used for its highest and best use. And your highest and best use might not be out there hustling for junky fourplexes, calling up flooring companies and eviction attorneys.
It usually isn't, and it takes some people a few years to realize that.
Yeah, it's not as easy as you think. It's not easy. It sounds like, oh, well, this is relatively paint by numbers, but I'm telling you, it's not that easy. It takes a lot of work, a lot of patience, and you have to have a thick skin to run contractors and buy distressed assets. Anybody who's done it will agree. Anybody who's not is thinking, nah, you're full of it. Try it and get back to me. Yeah, that's tough. So what we have is a different kind of value add. So we sell most of our fourplexes pre-construction. So what happens is we get a project all set. We typically start advertising a project when we're about 95% sure that this thing is going to go. Maybe we've already done projects in that city. We kind of know the city council is going to give us a rubber stamp here, for lack of a better term, and that this thing is going to work. When that happens, we'll start taking reservations, and we'll send our prospective clients a tentative plat map, and we'll send them all the projected financials, pro forma, and everything so that they can see, hey, this looks pretty good. I want to buy one of these things. So we set you up with our preferred lender who gets you approved for construction financing. And so when you fast forward down the road, say anywhere from 4 to 6 months, and it's time to start construction on your fourplex, you close on a construction loan. And it's going to take about 12 months to build that fourplex. If it was just one fourplex, it'd be 6 months, but we're talking about a whole project here with amenities, and there are a lot of moving parts. So it's about 12 before you're rent ready. Now, when you do it like this, you took out construction financing. You bought this thing based on a pro forma, and you researched insurance costs and taxes and rents and values, and you said, okay, this is a pro forma, right? Pro formas are never 100% accurate, but this is pretty close. I'm comfortable with these numbers.
Yeah.
And you took on that risk of closing on construction financing, paying the interest during the build, accepting the fact that your long-term interest rate might be higher when you're done building, right? You've got some uncertainty here. But when you get to the finish line and this thing is done and you refinance out of that construction loan into a 30-year fixed rate mortgage, the builder gave you a much better price than if he built this, tenants in it, and sold it to you risk-free. You took on risk. That's your value add. You, the busy investor that has a job and you don't have time to be a traditional value add investor, your value was, I've got capital. I'm going to put it down. I'm going to have the builder do this thing. And you waiting through that process was your version of value add. So what we usually see is a spread of about 2% on the cap rate. So the open market, at least in the markets where we operate, you can buy fourplexes in that 4 to 5% cap. When we sell them pre-construction, you're typically get them in at about a 7% cap rate. And so that's what people kind of say is they go, well, I could go try to find a value add opportunity. There's a lot of uncertainty in that. Be a general contractor and go through this process. Or I could just get something brand new that's townhouse style and get a 7% cap rate. That's why most people say, yeah, I'd just rather do business with FIG. That's more my value add is I'll be the money and be patient on that side of it.
Yeah, well, you attract investors before a property is built. So therefore, after waiting for a few months, the investor goes ahead and they get in on a construction loan, which they might hold for about 12 months. And then once construction is completed, that transitions into a conventional loan. So therefore, for your investor, they took on a bit more risk. They put their capital out there prior to closing on the conventional loan and getting an income stream. And as a reward for that, you took some of the risk off the builder's shoulders. So just tell us a bit more about how that helps an investor. Since the investor took on that risk, how does that help them get a better cap rate?
Well, let me just give you a real world example. I would just give the disclaimer that this is one example. It happened, probably 6 months ago. It's fresh on my mind because I was talking to the client today.
Yeah.
I can't say it would go this way every time. This one happened here in our home market of Salt Lake City, Utah, which has been the hottest market of the three that we operate in, which are Boise, Idaho, and Houston, Texas as well.
Okay.
But this particular investor, about 2 years ago, went under contract on 2 fourplexes. These happened to be in American Fork, Utah. And forgive my fuzziness, I'm right within about $10,000 here. Okay, but they went under contract at about $680 per fourplex. They took out their construction loans. They let the builder draw on those to build them fourplexes. They went through the process. They went through their lease up, and now they had 2 fourplexes. And they kind of got to a place in their life where they actually needed a little bit of capital. And they called me and said, "Hey, Steve, what if we sold one of these things? Could we get our money back out?" And I said, "Well, based on what I'm seeing, the market absorbs fourplexes at about a 5% cap rate right now. Let me do a little research." I did a little research. I listed one of their fourplexes because they wanted to keep one of them for cash flow, kind of take half the money off the table,
okay,
so to speak. I listed one of them, and we had that thing gone in 2 weeks for $850. That's the difference. When you take the risk out of this thing, and now you have a standing built fourplex with tenants in it that's new, the open market pays more for that. It's just kind of an idea. They bought in the idea phase, Keith, right? And they were patient, and they went through it. So in that case, whatever that spread is between $850 and $680, that's the difference in a cap rate in real dollars that you can understand. And I'm not saying you can do that on every single one of these or that that's our main business model. It certainly is not. We're a cash flow company. But when you get that cap rate spread, yeah, you can put a dollar amount on that typically.
That is a great example of one investor using 2 different exit strategies with 2 different fourplexes, one that they're going to hold for income production for the long term, and the other one, which they held during construction loan, and once it's constructed, they effectively flipped it.
Right, exactly. And these kind of people that end up on the very end of the line that bought that fourplex for $850, like I said, they're very risk-averse investors. Maybe they sold a company. They just want conservative cash flow. We see a lot of investors coming out of California or Washington that sold properties, and they've got a 1031 exchange. So to them, a 5% cap rate on a brand new multifamily property is way better than paying $150,000 in capital gains tax, right? I'd just rather put that money to work. So it's a good win-win all around. And it certainly was in that example I gave you.
Yeah, absolutely. Now, you mentioned a few different parts of the nation, Utah, Idaho, Texas. Just give us an example of fourplex price points. You mentioned a couple in there, but what's typical?
We're recording this here in 2018, almost halfway through. So depending on when a listener is listening, just know that things can change a little bit. Utah is our home market. It's where we've done by far the most amount of doors. The funny thing that happens when FIG goes into a market is we almost create a new market. I'm sure you would agree, Keith, that I don't know of anybody that is building fourplexes in the quantity that we are. And so when we come into a market and start doing these, the market wakes up and you almost create a whole new property segment. And so it's running very optimized in Utah right now. We've got a project coming we'll release in a few weeks. It'll probably be about the time this airs, so your listeners will be able to take advantage if they want to. And the starting price is probably going to be about $730, maybe $740 in that project. And it depends on a few floor plan variations and such. Then mid this summer, we anticipate releasing a new project in Cypress, Texas. If you're not familiar with the Houston metropolitan area, Cypress is a city up in the northwest portion of the Houston metropolitan area. Great area. Anybody that knows Houston would agree with me there. And then we've got a project in Meridian, Idaho, which is a suburb of Boise, Idaho. I would expect to see the price points on those be in the high sixes for those projects. Houston may be a tad lower than Idaho. So yeah, you see Utah, you'll probably be $75K, sometimes more than these Idaho and Texas projects. Once again, very loose numbers, but that's what I expect to see.
We're talking with the FIG, the Fourplex Investment Group, Steve Olson, about the idea of owning brand new investor Fourplex buildings. More when we come back. I'm your host, Keith Weinhold. This is Get Rich Education. MC Lobsher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is Richard Duncan, publisher of Macro Watch. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Steve Olson about the FIG, the Fourplex Investment Group. You can learn more about them at fig.us. Steve, what you're doing is so interesting because you're coming in there and you're developing a large tract of land with many buildings. And you know what? When you do it that way, you kind of control the neighborhoods. You've taken away some of that risk that you see, maybe with these older 1985 built fourplexes or whatever, where you don't have any control over what your neighbor does. And what your neighbor does can often bring down your property value. Tell us more about controlling the neighborhood.
Well, we become the neighborhood, right? Depending on how big the project is and where we buy. But, you've got that stabilization period that a project goes through, like an apartment complex, right? I was just analyzing a complex today that will be competition for one of our upcoming projects. And it was about a 320 unit complex, and it took them a year to stabilize it and rent it out. And that's normal. It's actually pretty good for that many units, believe it or not. But that's what happens when you lease this thing all the way up. You really are the neighborhood. So you're really less concerned about these houses around the corner or what's going on with them. Don't get me wrong, they're always in the equation. But when you're doing big projects like this, you're kind of the big dog on the block. You become the neighborhood.
One of the things I like the most about the Fourplex building, that's the fact that you basically get a small multifamily property, but yet you get the advantage of residential financing, which is, I think, typically pretty preferable to apartment investor financing. And it's typically going to be, 25% down and a 75% loan on a fourplex building with a conventional loan.
To me, that's one of the best parts about what we're doing here. You're referring to those conventional loans. Some people call them Fannie Mae loans, which depending on your credit and your down payment resources, you may be able to get up to 10 of those, right? So why not get 40 doors instead of 10 doors, right? Why not maximize the amount of doors with the best financing that there is? And it's the best because typically you're getting the lowest interest rate and you don't have that obnoxious balloon payment or any adjustable, right? You don't have to deal with that stuff that can be there on a lot of the commercial financing. And if you're a pro at apartment buildings and such, you know how to navigate that. But man, having that 30-year fixed rate mortgage that has no balloon just gives you so many options, right? So it allows you to maximize what I think is the best loan product out there.
I've owned a number of fourplexes in my life. I think one can contend that, especially from a financing perspective, fourplexes are better than a lot of fiveplexes and sixplexes that you have out there, because once you go to 5+ units, now you have a DCR threshold that you need to meet. Now prepayment penalties get introduced. And then the big one that you touched on, to your point, is balloons. And for those that don't know, with a balloon loan, that means basically from the time that you originate your loan on these 5+ unit properties, you are on the countdown clock. Oftentimes, you have a balloon because your loan matures at 5, 7, or 10 years, even though it might be on a 25 or 30-year amortization. And when that clock ticks down to zero from 5, 7, or 10 years, that means that that entire note gets called due. That's why it blows up like a balloon. That's why it's called a balloon. And basically, when your balloon loan matures at 5, 7, or 10 years, like you see with a lot of apartment buildings, you basically have three choices. Number one, you can sell. Number two, you got to hope you have sufficient equity for a finance. Or number three is probably the least palatable option of all. You can pay it all off with your liquid funds. Well, a fourplex avoids all of that.
That's right, because you're at the mercy. You don't know what the market's going to look like when that balloon comes around to get you, right? So you don't know what'll have happened to all those factors that influence whether you can pay it off, whether you can refinance, or if you can sell it for what you owe. Who knows, right? So yeah, that's risky. Like I said, if you're a pro, you can navigate those waters, but you just really take that card off the table completely with a 30-year fully amortized loan, right? You can sail right through those uncertain times because nobody's going to be hitting you up with a balloon payment. It's pretty great.
That's right. You've got that 30 years of certainty, and then if rates drop, you have the option of refinancing if you want to, but you don't have to. And you want to eliminate have-tos from your life as much as you can, I would contend.
Oh, yeah. That's like one of the top 5 things that'll make you a successful real estate investor is don't put yourself in a position where you have to do anything. And that 30-year fixed rate mortgage, you've got options.
Right. As an investor in real estate or anything, you don't want to be in that position where you have to sell or liquidate. And sometimes balloons put people in that position. You're not in that position with a fourplex loan. And, I checked recently, and the Freddie Mac loan limit on a fourplex is about $870,000. Tell us about property management on these fourplex neighborhoods.
Well, when we first started doing this, we were probably naive. We just told all of our investors, yeah, get whoever you want to manage it. But then you got too many managers walking around that development, quoting different rents, using different tactics, and you begin to pit everybody against one another.
Right.
So if you get somebody that really needs those funds and they tell their manager to cut rents by $300, that's very undesirable domino effect through the whole project. So we instituted a requirement that our property management within our brokerage here at RE/MAX be used for the first 2 years, because then you can stabilize the development. You can charge the optimal rents. And then in 2 years, if you don't want to use us anymore, that's fine, because there's no arguing about what market rent is at that point. We've got so many signed leases that show that it's $1,450 a month or whatever it is. So we instituted that requirement, and sometimes people say, oh, well, can I manage it on my own? And that might be a deal breaker for me. It's a deal breaker for us, right? You stick within the system and you'll be happier because we can rotate through, we can fill this in the best way possible and get the most rents for everybody. Because remember, Keith, fourplexes are kind of funny. They straddle that world between residential and commercial. You're using financing that's actually very common in the single family world, but you're valuing these properties by the cap rate. And residential appraisers, they don't care about cap rates.
Right.
I can tell you that much. So if you go slash your rents, guess what? Your cap rate just went way down. Your fourplex value just went way down. So, if we ever end up talking, if you're listening to the show, we'll walk you through the expected cash outlays, what we think are some good ideas on reserves and things, so that you can get through that initial stabilization period and get the best rent possible to make your fourplex be worth as much as possible.
You're buying a fourplex there as the investor based on the income that it generates, but appraisers typically use comparables when they're going ahead and valuing these properties. And actually, Steve, when you develop an area and basically a neighborhood of fourplexes, sometimes you do have more than just fourplexes.
Yeah, that happens. We do these mostly townhouse style. So what'll happen is obviously our builder team wants to make as much money as they can. They want to get as many units as they can onto a parcel of land. And so maybe the setback and the engineering requirements will allow them to put, say, 6 townhouses in a row in one particular section of the project. So they might decide to plat that as a fourplex and a duplex or 2 triplexes. So most of our projects are usually like 80 to 90% fourplexes, but when you've got those straggler units, we'll plat a few on there as duplexes and tris. So if that's more your thing, or maybe a quad isn't in your budget, there might be a smaller unit that could work for you.
Now, last time we had a lender here on the show, I believe it was also 25% down on duplexes. What is the typical price point for a duplex?
In Utah, you'll probably be at about 400. In Texas and Idaho, I could see you being 375-ish for a duplex. Like I said, it does depend on the area, does depend on a few different factors, but those are some of the more recent figures that I've seen.
Okay, well, this is a niche where I'm really glad that you're filling it, because there just aren't that many duplex, triplex, and fourplexes available. And a lot of that reason is there isn't any new construction of those things, but you found a need and you're filling it. So if an investor wants to get started or think about getting into a brand new fourplex or maybe even a duplex, what's the best thing for them to do?
Well, there's two ways they could go about it. Number one, they could shoot me an email and I'll reply. My email address is solson, that's SOLSON @fig.us, SOLSON @fig.us, or just go to our website, www.fig.us.
Steve Olson, I'm really glad that you offered this, and it's been great having you on the show.
It was a pleasure, Keith. Thanks a lot.
Oh, it was great hearing from Steve. I love what they're doing there. You don't often find a specialist in the duplex to fourplex space like this. This is a super interesting concept. It's kind of like Fig has said this. They've kind of said, like, we've seen what the experience has been over a few decades with fourplex neighborhoods elsewhere, so we're going to find a systematic way to head this off and basically be the sheriffs in town. So investors are going to have their capital tied up longer before occupancy. But as you saw, that can bring you some certain advantages too. Now, you'll still have some stabilization during lease up as well. So it's kind of a more patient dollar that we're talking about here. This can be a great way for you to get some economies of scale, still get the 30-year fixed financing, which has been my favorite loan ever since the beginning of this show and before. And you can still get a durable asset in its new construction. Now, this won't fit you so well if you're just trying to string together $20K for your next single-family income property, because you're looking at a 25% down payment on an asset of $650K or maybe $700K or more, unless you want a duplex that makes use of this same model for about half that price. Hey, next week, it's only going to be me talking to you directly, as I'm going to talk to you about rent control and rent problems. How rent control, that's when governments put a ceiling on how much rent one can charge, how that often backfires and ends up hurting the very people that it was intended to protect. I'm also going to tell you about just some various rent problems, including one for my own rental portfolio, since problems are often where we get the lesson. A big thanks to our guest, Steve Olson, today. If you want to see what it takes to get started, his contact info is in the show notes for you, of course. If you're interested in the idea of a brand new fourplex or maybe a duplex, email Steve or just check out fig.us. I'm your host, Keith Weinhold, and I'll be back next week to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention, as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. And I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's BRADSUMROK.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.